And I'm back. Today is March 11th, 2020, as in the S&P 500 closed at 2741. And now the market pace is open. As I started the last video, I want to start with the change from the last episode. The S&P 500 has dropped 15% since the last time I was on here. And the market status was pretty worrisome to uncertain to now it's just volatile and pretty likely to go down further. I was in a delta neutral portfolio, which kept my balance as a total flat during this whole change, and right now I'm staying in that position. I wish I could take some sort of trades that would profit off of stocks dropping, but the volatility is so high, and as stocks kind of just go crazy, they have big rises really fast, big falls really fast, and there's just not enough certainty at any one point in time to make sure I don't get caught up in one of those spikes up or one of those spikes down that I don't want to be caught up in. So the volatility is just too high to really trade right now, and if I were to use options to make the risk worthwhile, it's also too expensive due to the volatility. Options get very pricey as markets get more and more wild. So that's kind of where the market changed from the last episode. I do, of course, also want to go into the trades I had mentioned in the last episode, such as currencies, bonds, and interest rates. So that's sort of the what happened section. Then get into what is happening right now, which is going to be affecting the markets currently and into the near future. And also my predictions on what will happen over the next couple of weeks to maybe months. Of course, before we do any of that, just a quick mandatory disclosure here. I do want to make sure anyone watching this video knows I'm not a financial advisor and I'm not providing financial advice in this video. All I'm doing is sharing information that I have seen publicly and my opinion on it, as well as a couple of the sorts of trades and actions I'm taking or planning on taking as a result of those new developments and news. And as you could probably guess from that, I likely have or I'm planning on opening positions mentioned in this video. I'm going to start with the US dollar. In the last video I did say that it was way too high, and that last video was around up here in this 99 level, and since then with the Federal Reserve lowering interest rates, the dollar has crashed quite significantly down to 94.81, so that's a good change. We actually kind of wanted to see this dollar drop. It helps our market stay a lot stronger in the weakening global developments that are going on with this coronavirus, and the effects of it, namely the whole quarantines. I did also mention that foreign currencies were too weak. They were around here when my last video was posted. Since then, they did take a nice rise, the euro especially. The Great British Pound did do the same thing to a lesser degree, same thing with the Chinese yen, but this is definitely the most pronounced of all of them. And honestly, the euro is the best hedge against the dollar, so this is kind of where we would expect to see the change the most, and we did see the change the most here. So all is right with the currency markets. I did also mention that bonds were ready to shoot to really higher highs, as they did, again in response to the Federal Reserve lowering interest rates, which we were expecting as well. So all that did happen and fixed a lot of major problems that were going on in the market, causing it to drop. However, at the same time, the coronavirus fears kept creeping, and now we're facing a good amount of quarantines that are happening in different states and countries. And that's leading to also a lot less travel, a lot less people going out to buy and spend money on entertainment and several other factors, which is for sure a definite drag on the economy. And then late last week, over the weekend, we had Saudi Arabia come out and say they are going to start pumping and start flooding the oil markets with oil to lower the price and have a price war in a way with Russia. Last week there was an OPEC meeting where they were trying to jointly have production cuts, but Russia did kind of back out of this, and since then Russia and Saudi Arabia are kind of going at it now. So we're seeing the effects of that on the oil market, which was this rather large dropped from 45 to almost $27, and then a small bounce, and now we're heading back down as well. And on top of that, just today, late today, Trump had announced more travel restrictions. Again, this is going to hurt the demand of oil and hurt spending as a result of coronavirus and these oil developments. So we still now have two really big drags on the economy, this coronavirus and the oil OPEC Russia disagreement. Oil and OPEC and Russia, that eventually will sort itself out. The coronavirus thing is going to be something that takes some time to really sort out and have the economy come back to booming and bustling and making up that drag on GDP and drag on revenues and profits that companies would otherwise be seeing right now. But they're not seeing it since people are staying inside, kind of afraid of the virus, which in some ways I can understand, in other ways is a bit of an overreaction. However, we'll see what happens with it. I'm just trying to play the market the best I can. So that is everything that has happened with the currencies and the bonds, and everything that is still happening with coronavirus and oil, mainly the quarantines and travel restrictions. So what will happen? Let's get into that. Let's move into the S&P 500 chart. This is a daily chart here. I did lay out this range in the last episode from about 2,900 to 3115, let's call it, 3110. It did stay in that range for a little bit, and then a few days ago it did break out. This happened, let's see, what's that? Yeah, this happened right after OPEC and Saudi Arabia and the Russia disagreement happened over the weekend, and stocks actually hit a circuit breaker. They dropped 7%, which caused trading to stop 50 minutes, which was the first time in my life I got to see that, and it was almost exciting in a way if it wasn't for horrible reasons of people losing 7% of their net worth overnight. But hey, sometimes bad stuff happens, I guess. It is still kind of cool to see, I have to admit. Let me get back to what I was saying though. The S&P 500 did drop out of this range, which does kind of signal that lower lows are very likely to happen, since they've lost a lot of the support that they had in this range here. The next spot I could see it falling to is actually on the weekly, so let me change to weekly. Here would likely be this 200-day moving average as shown in this green line, which is about 2670, 2680. And actually, as I'm doing this, the futures market is floating just above 2600, so it looks like we're going to hit that mark and overshoot it, and we'll see what happens during the trading day tomorrow, on the 12th, if it comes back up as support or if it maybe meets as resistance. We'll have to see. Let me get rid of this stupid ad. All right, so yeah, we'll have to see what happens tomorrow, but this is the region where things are actually starting to look kind of cheap, where you might want to start thinking about getting back in. I'm thinking about it around now. I'm just waiting for things to kind of sort themselves out. Maybe at least OPEC and Russia, or maybe to hear what the Fed says on the 18th from their FOMC meeting. Essentially, though, this is what I think will happen over the next 2 weeks and maybe the month. We'll hit this 2600 mark, which we already did, and probably trade around here. It may act as some resistance from it going back up and fall maybe down to 2400 the last time it had support here. So I think that might be the new range, 2400 out to 2650, until we hear from the Federal Reserve on the 18th. As a result, though, I'm still staying in a delta neutral portfolio. I really don't have that great of an idea of where things are heading. They're likely heading lower, which, like I said before, it's hard to make a trade out of it due to how much volatility there is. Or the Federal Reserve has just been pumping money into the economy, and the government is also starting to come up with some fiscal stimulus to, again, pump money into the economy to help spur spending and help people stay from being recluses into their own houses and getting them out. If it does take hold, then we could see the market coming back up very sharply and very quickly, and I really don't want to miss it. And I've already sat out 15% of this drop, so there really shouldn't be too much more. Of course, the market loves to make you bite your words on that type of stuff. But overall, I know right now, volatility is crazy high, and I'm not losing or making any money sitting on the sidelines, and I'm okay with that while things are going crazy in the game. So I've mentioned volatility a lot of times in this video, and I do want to cover this index called the VIX, the VIX. It does have a pretty good gauge of volatility in the market and kind of the fear of the market, and it's just a good time to mention that, I guess, for people watching this. It's a nice thing to learn and investment strategies and kind of taking it into account in your investment decisions. So right now, this is the volatility index, and right now it's at 53.9. This is a pretty high number for this gauge. And as this number gets higher, the more the market is likely to move on a day-to-day basis. So with this high number, we could expect very high volatile moves. And right now we've been getting moves to the tune of 3 to 5%, 7% some days. So it's a pretty good measure. The only other real times it gets this high are during major crises, or at least major drops in the market. We had a nice 20% drop around 2018, a nice 10 to 15% drop in the start of 2019, 2015 and 2016. We had some oil issues going on. The last time it was this high was, let me go back to it. It's almost there. It is, that big spike in, you guessed it, 2008. So we still shouldn't see a financial crisis like 2008 that would last this long, but according to the VIX index, things are that serious. So that's another major reason why I'm kind of sitting on the sidelines, waiting for things to develop, waiting to see how serious this really ends up being. If it is just going to be a quick recession, things slow down, then things pick up and we continue on our way, or if it's going to be some sort of issue that leads to major problems that we have to fix and actually find the solution and then go about fixing it. And that'll take some time to continue back up and going along our way. But I do know this, over time, this will drop, and 55, 53 is not a stable number for this. It's more, usually likes to be around 15 to 20. So a major trade that I'm looking into, however, I have no idea when I would put it on or replace it, is shorting this VIX. And I want to show you this symbol here, TVIX or TVIX. And this is pretty much the best way to go short an index like the VIX. Overall, it just, for the most part, goes down over time due to the readjustments that it gets periodically. So this is the best way to short the VIX because it readjusts in a way that always causes it to go down. So you have a good way to win that way, as well as have a way to win by just the VIX flat out falling quickly. Which, once things do start to settle down, the virus, I guess, has some sort of remedies, some cures, vaccines, and OPEC kind of sorts out their production, then we have no reason really to see the VIX continue upwards, which would be a great time to start shorting it and watch it drop 50% over the course of a week or two, making for a great short opportunity. I have no idea when it'll happen, though. I'm just expecting it to happen at some point as things simmer down. And that's about all I have for the market recap. So, got one last thing for you, and then I'll see you next time. Next time we see some changes in the market. So, last thing to leave you with: who doesn't love a good Warren Buffett quote? This is probably one of my favorites, and really the truest thing you could really say in investing. Rule number 1: don't lose money. Rule number 2: never forget rule number 1. As long as you keep your capital safe during the times of uncertainty, there will be times of certainty, either going up or down, that you can make money with that money. So preserve it, save it for the time that's right, and then use it when that time is right. Now, of course, there is the whole buy and hold and just ride out the waves. Overall, the markets, the S&P 500 indexes will continue up. There's nothing wrong with that either. That does yield an average 8% per year, and that kicks the ass of any CD or savings account out there. I keep my ear to the ground though all the time, and I have periods that are certain that things are going to go up. I have periods that are certain things are going to go down. I have periods that I have no idea what's going to happen. So I kind of just agree with this. Always protect your money and use it efficiently when you can, and you'll do pretty well in the investment world, just as Warren Buffett has. So with that, I leave you, and good luck and happy trading.